Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this video I'm going to cover mutual funds. So we'll give a brief description of what a mutual fund is, the different types of mutual funds, and then as usual we'll look into the pros and cons of mutual funds and the different alternatives that are available as well. So what is a mutual fund? A mutual fund is a type of financial vehicle where the money is pooled from a collection of lots of different investors. This money is usually actively managed by professional money managers and invested in securities such as stocks, bonds and other assets. So the origins of mutual funds can be traced back to the Netherlands in the 18th century. A fund was created to give the individual investors who didn't have much money the opportunity to kind of join a fund of a lot of other people, which gave them access to a lot of different diverse investments. Unlike normal stocks on an exchange, a mutual fund does not trade during the day. So the price of the mutual fund is closed overnight once the market is shut, and then that price is calculated at the end of each day. So let's take a look at the different types of mutual funds. So first we've got equity funds. These are focused mainly around stocks. And then fixed income funds, these are focused on bonds. Then we have balance funds, which is a combination of both stocks and bonds. Index funds, these are designed to track a specific index, such as the S&P 500 or the FTSE 100. Money market funds, so these consist of extremely safe financial instruments such as government treasury bills. These are very liquid assets, so you can access the cash quickly and easily, but as a result of this, the returns are low. Then we've got income funds. These are usually used by retirees and conservative investors to give fixed income for them once they already have a large principal amount. So that's why it's useful in retirement. And finally, international and global funds. So these are invested in global assets, and they can be used to balance a portfolio by offering diversification across different markets around the world. If you sign up to an actively managed fund, you'll normally be assigned a portfolio or investment manager, and the manager will they'll do an interview with you to ascertain what your time horizons are, how much money you've got to spend, your risk tolerance, and from this sort of questionnaire they'll build up a profile of you, and then they'll actually allocate different stocks and shares based on the outcome that you're looking for within the portfolio. So if you look at the benefits of active versus passive funds, with an active fund, obviously you've got dedicated professionals who are actually trying to beat the market. Unlike if you're passively investing in an index fund which tracks the market, then obviously all you can really hope for there is to get the same returns as the market. So let's look at how we make money in mutual funds. So the first way we can make money from the funds is through dividends. And through a mutual fund, we can get dividend reinvestment. That means any of the companies or the stocks within our fund, if they're paying a dividend, then that dividend comes to us and then gets automatically reinvested back into the mutual fund itself. So that helps to accelerate the growth of it as well. And another way we can make money from the mutual fund is through capital gains. So we might buy the fund and have $50,000 in it, for example, and then over time the price of that fund has now gone up to $70,000. So then we could sell the fund and make the profit on that from the amount that the fund has actually risen in value over the time. One thing to keep an eye on with the mutual fund is definitely the fees. So you will have an expense ratio, which is the cost of the management fee. So you might pay 1% or 1.5% depending on the particular fund. So remember that this 1.5% is paid on the total amount that you have sat within the fund. So if you've got $10,000 in the fund and you're paying a 1% expense ratio, then you're going to be paying $100 a year for that fund. The second way is the trading expense ratio. So obviously if you've got an active portfolio manager and they're trading in stocks and bonds within your portfolio, there's going to be a certain amount of transaction fees for completing all those trades. So if they're moving a lot of different stocks around based on your particular requirement for your portfolio, then you're going to expect that there's going to be fees attached to that, which they will also take from you. And another fee we're looking at is sales load fees. So you can have a front end fee. So that's where they take the money off you in the first place. So when you first create the fund, so maybe you put $1,000 in the first place, they will take a percentage of that. Say they take 5%, that's $50. So straight away, that's kind of a front end fee. So they've already taken the $50 off you at the beginning. And then you'll also get a back end fee, or otherwise known as a deferred fee. So that's slightly more beneficial than the front end, because if you're paying the fee at the front end, that means you're losing like quite a lot of compounding value over on the initial investment. I think it's also good to go and take a look at the difference that the fees can make. You'll see one fund where we're making a 10% return, and another where we're making an 8.5% return, just so we can kind of compare how that 1.5% makes a difference. So let's go and look at that now. So here we can see a comparison of different compound growth rates. So if you think that the difference between like 1 to 1.5% isn't much, it's kind of quite interesting to look at this graph here. So this is based on, you can see the green is like a compound growth of 10% per year. And this is based on an initial investment of $1,000 and then also putting in $1,000 every month. And then that compounds at 10% per year. And then we can see the blue here, the compound growth here is 8.5%. So just 1.5% difference. And then you can see that obviously for the first 10 to 15 years of the investment, you really don't notice much difference. But then obviously the important thing with compounding is time. So once you see the time kind of going by to the 20, 25 years, you see that obviously the green really starts to kind of accelerate exponentially away from the blue. So we can see here that the difference actually ends up being just under $1.7 million. So that's just from the 1.5% difference. So this is a good illustration to show that if you think that a smaller percentage amount is not important, then this really illustrates that it makes a huge difference over a long period of time, like 40 years. And now let's go and have a look at the pros and cons of mutual funds. So the first one is that they're professionally managed, and then we have the possibility to outperform the market average. They're good also because they provide easy diversification for kind of low minimum investment costs, and you can get started with quite a small amount, maybe like it could be $500 or something like that. And also you get the chance to do dividend reinvestments, and that will automatically happen as you receive dividends into the fund. Now let's have a look at the mutual fund cons. So the high fees can really eat into your gains and returns over time. With these fees, you will need to pay them regardless of the performance of your fund or the portfolio. So you might be losing money every year, the value is going down, but you will still pay that management fee out to the fund manager. And you also don't have control over the assets which the fund is invested in. So you might not like some of the companies that you see that the fund is invested in. And obviously, if you're picking your own individual ETFs or stocks perhaps, then you have the power and you have the choice to select something that matches more closely to your values. And according to a report from Morningstar, only 24% of all active funds beat the average of their rival index funds. So this was kind of research taken from Morningstar over the last 10 years. I'll actually put this in the description as well, so you can go and look at the article. But that's kind of quite interesting to see that only a small amount of mutual funds actually outperform the market anyway. So that's something also worth considering when you're looking into investing in a mutual fund. So how about the different alternatives to mutual funds? So I've done a previous video on ETFs, so I'll put a link up there. You should see that on the screen in a minute, because that's one alternative to mutual funds. And another alternative would be to invest in individual stocks. Now that's something which is obviously like a lot more time consuming, because you have to do all your due diligence on all the individual stocks. And of course, if you're doing that, you don't get the same level of diversification that you would do in a mutual fund or an index fund or even an ETF for that matter. But obviously if you're doing that individually, you've got the chance to get greater returns by being able to pick the individual stocks that you kind of think are going to be the really big returns in a period of maybe the next 10 years. So now let's consider the key takeaways from mutual funds. So I think it's always important to look carefully at the fee structure of the actual mutual fund before you're going to be investing in it. You need to kind of carefully consider this, look at all the fees, and then kind of make an educated choice of whether you think that that particular fund, its track record is going to make you better returns than the market. Because if you're paying for an actively managed fund, you kind of need that fund to be making a higher percentage, like actually beating the market. Otherwise, you could just stick your money in a passive fund and you wouldn't pay anywhere near as much fees for that. And the next point is actively managed funds offer the opportunity to beat the market returns. But having said that, not many actually do. And you need to consider if you prefer to take control of your own investments or trust this to a professional manager. So that's kind of a personal choice around that. If you're not comfortable with making your own stock picks or investments, then obviously this is where the kind of professional management really comes into its own. And finally, I'd always say to always explore the different options available when making investments. There's a lot of them out there, but you really kind of just need to carefully consider each one before making a final investment decision. So that's it for the video. I hope you enjoyed it. If you did enjoy it, please hit like and also consider subscribing to the channel if you're not already. That would really help me out, and you will also get notifications of when I'm going to release new videos as well. So thanks for watching, and I'll see you in the next video. Cheers.